Hey, it's Jason Hartman with episode 2012 coming to you from beautiful Bavaria, Germany. And today we have a great interview that I did with my friend Bronson Hill. And before we get to that, I just want to remind you of one important real estate investing lesson: the amazing resilience and durability of our favorite asset class, the most historically proven asset class in the entire world. I am at beautiful Neuschwanstein Castle, and this was built over 100 years ago, and what do you want to bet that it will be here thousands of years from now? Now, your income properties may not last that long, but they will probably be here in 100 years or 150 years, or maybe even more. And I just encourage you to really think deeply about the amazing durability of our favorite asset class. And if you have a chance, come and tour this beautiful, beautiful castle. It's really more of a palace because it wasn't built for protection or wartime as much as most castles are, but they call it a castle. So castle, palace, whatever you want to call it. But it is truly amazing, and you are an investor in the world's most amazing asset class. So congratulations to you on that, and let's go to today's interview.
Let's talk a little bit about what's happening. Last time you were on, we were talking about inflation-induced debt destruction. Can you talk a little bit about kind of what you have seen happen this year or even in the last 6 months in real estate? I think you'd said this about a year ago. You said, yeah, at some point, sellers are going to have to be okay taking less. And we're seeing that now, right? Especially in single family and certain types of assets. But what are you seeing in the real estate market, and what's kind of happening right now from your perspective?
Well, as you know from listening to my show, you know that a question I'm always posing that's rhetorical to my listeners is compared to what, right? And one of the big mistakes, Bronson, I see people making right now and really over the past year especially, is that they are comparing the time we have now with this historic increase in interest rates because the Fed has totally messed this up so badly. I'll talk about that and I'll comment on that in just a moment. We've had this historical increase in interest rates, and everybody's comparing it to what we had during this historical decline in interest rates. And neither of those are a good benchmark, right? What we need to do is go back all the way to 2019, which is not very far back, okay? But, I'm being sarcastic about that because what we had during the COVID era is a total anomaly. That is not a benchmark, okay, folks? That was a weird time. We can all agree on that. It's nothing to compare anything to. When I hear and see these people out in the media saying, well, the typical house payment has increased by 30%. Well, compared to what? Compared to the lowest interest rates in 5,000 years. And by the way, that's actually true. Wow. Check out a great book by the late David Graeber called Debt, the First 5,000 Years. It's an excellent book. Never got to interview him on my show. He passed away at a young age, unfortunately, but really good book, Debt, the First 5,000 Years. And they've actually kept track of interest rates for 5,000 years, believe it or not. And during COVID, we had free money. It is not anything to compare anything to because it was a complete outlier. So if you go back to 2019 or 2018 or 2008 during the great financial crisis, or 2000 or the 90s or the 80s or whatever, you really see that real estate is not really that expensive right now. Now, when you look at expensive, you've got to think of the price of the property, of course. And that's what most people do, but that's really kind of an amateur view of it, as you know. We've got to look at the cost of the property, right? The monthly cost of the property, because that's the way most people buy a property. And so when we look at it that way, it's really not very expensive. And I know that flies in the face of what a lot of people think. And they say, well, when my parents bought their first house, it was only $80,000. Well, a lot of inflation has occurred since then, changes in interest rates, incomes have increased. It's all relative. That's right. My point.
Yeah, I saw you did a video recently about this where you were comparing I think it was a house that a friend of yours had bought in Irvine, California, and they were paying so much per month. And if you looked at kind of what they were paying now with the inflation adjusted, this is like 30, 40 years ago. Well, not that, maybe 30 years ago. They were paying almost exactly the same amount when you actually
Yeah.
consider inflation.
Oh, I know the example you're talking about. Yeah, that was actually my ex-girlfriend. So
Right.
she bought this little condo in Irvine, California, and I was her realtor. That's how we met. Okay, and we got together after the transaction was complete, and she bought a condo from me, and it was like $170,000, I think was the example. And that same condo, I went back and repriced the exact same property. So you have a comparison that's apples to apples. It's the exact same property, right? And of course, it's much more expensive in quotes now, right? But not really, because when you consider inflation and you consider interest rates and you consider the real monthly cost of that house, it's actually about the same.
Right.
When everybody thinks it's so expensive. But there's more. And here's a sad commentary on society today. So when we try to figure out whether something is cheap or expensive, that gives us an impression as to whether the values are going to increase or decrease. Because if it's expensive, they're likely to go down. And if it's cheap,
Right.
they're likely to go up, because that's just the force of the free market, right? But what's interesting about that is she, at the time, was 26 years old. Okay. And I remember lots of people when I was in traditional real estate who were in their mid 20s buying their first condo. And nowadays, those same people that are 35 and 40 years old are living with their parents.
Right. Right.
So
Especially in
we've
big
got to,
metro areas. Yeah. Especially in areas like LA.
yeah. So we've got to ask why, what happened? Well, first of all, it's complicated because there are different segments of the population and so on and so forth, right? So some people are winning and some are getting by and some are losing, right? But overall, the middle class is under attack. There's no question about it. And the middle class is getting poorer. And I think that bodes very badly for the country, because if you want a strong, stable society, you need a large middle class. That's one of the things that's always made the US great. And sadly, that is evaporating. It's been evaporating for a few decades.
Right. So yeah, that's a great point. Well, I have a question for you, and this is shifting gears a little bit, but the Fed has been raising rates since March of 2022. My friend Jeff Clark, who's really a metals guy, has talked about saying that the average the last 70 to 100 years is 5 months from the time of the first rate hike to when they start cutting. The longest it's ever been, I guess, since the Federal Reserve was created was 13 months. Do you think it will last longer? Do you think the Fed will stay true to their word and they will continue to raise or hold rates throughout 2023? What's kind of your perspective, at least right now at the end of 2023?
Interest rates are very hard to predict. One of the leaders in that field is Jim Grant, Grant's Interest Rate Observer. Ask him. He knows better than I do. But I think what will happen is really, overall in the macro view, pretty simple. They're going to bump it up maybe 2 more times. And they're going to push us into a recession. Many argue that we're already in one. It's sort of hard because the typical technical definition, 2 quarters, we all know that one. But unemployment is so low and there's such scarcity in many segments of the economy that it's sort of hard to say we're in a recession. So, a recession is actually declared by a committee, believe it or
Right.
not.
Huh,
So that's actually people on a committee decide if we're in a recession or not. That's the actual way it happens.
Huh.
Now, the academic one is the 2 quarters of declining GDP.
Right.
So, whatever, it just depends. I think the best way to look at it is the way Ronald Reagan used to say. And he used to say, when your neighbor loses his job, it's a recession. When you lose your job, it's a depression.
Right. So, yeah. And you're depressed too, right?
Yeah. So the point is, the Fed will screw up the economy as they always do, and then they will back off and they'll start to lower the rates again and loosen the money supply. Having a centrally planned economy it doesn't work. Okay. The free market should decide interest rates. The cost of money should be decided like the cost of everything else in the marketplace. It should be a free market of buyers and sellers that come together and have a meeting of the minds. And if you want to loan me the money at this rate and I want to borrow the money at that rate, we have a deal, right? Why should we have a central bank doing this? So we shouldn't have a central bank at all, but that's a whole nother rabbit hole.
Yeah, no, absolutely. That's really good. Bloomberg came out with an article a few weeks ago that said that Americans in 2022 at this time have 5 trillion in savings in their savings and bank accounts. And it was the highest they'd had previous to this point was 1 trillion, which was in 2020, right before the pandemic. So all this money is on the sidelines. I'm wondering if a lot of money will flood back in when rates start dropping, or people are just kind of waiting for that rainy day. But do you see the future for real estate being pretty bright? Do you think we're going to have, obviously real estate there's many asset classes, it's not one asset class, single family is, depending where you're buying and how it's working, but do you have any opinions on kind of how that will play out with the scenario you mentioned?
Well, I think single family homes are going to do very well, but you have to divide that up into the 3 broad types of markets that I always teach: linear markets, cyclical markets, and hybrid markets. Cyclical markets are the trophy markets that everybody talks about, thinks about: the West Coast of the United States, the expensive Northeastern markets, South Florida, where I live. Those are all cyclical markets. Around the world, cyclical markets are Paris, London, Dubai, Hong Kong, places like that, right? They're all these trophy markets, and they're really expensive. And if you want to know, am I in a cyclical market or a linear market, it's pretty easy to tell. And I'll tell you how. You don't need to look at a chart and figure out what happened in the past. Was it like a roller coaster up and down? That is a cyclical market. That's what happens in a cyclical market. But you can know if you're in one or not by land prices. So if land is expensive, it's a cyclical market. And if it's cheap, it's a linear market. Okay. So linear market is one of those markets where if you're looking at a chart, the prices have minor ups and downs, but overall it's relatively steady upward progression at somewhere around 6% annually. Okay. That's going to be the normal thing. But cyclical markets up and down. So the cyclical markets are suffering now, and they're going to suffer more. The linear markets are going to do much, much better, as they always do. However, you need to also segment by product type, by price. As you know, you can peel this onion a lot, but lower priced entry level houses that are typically purchased by investors, those are going to do very well because there's a massive shortage of them. To any real extent, Bronson, they've hardly built any of them over the last 14 years. There is a huge shortage. There is a ton of household formation of all those millennials and soon to be Zoomers living at home with their parents that are going to move out eventually.
At age 42, right?
Yeah, maybe age 48, actually, but maybe. And they're going to buy a house and they're going to form a household, later, but they're still going to do it, to some degree. And so there's a lot of pent up demand that's called shadow demand. But there's real demand that we know about that's not being satisfied now because the inventory of housing is so low. And look, everybody listening has got to understand something. Of all those people out there saying that there's going to be a market crash, and believe me, if I thought there was going to be a market crash, I would be saying it because I would love to be right about it, And I'd love to have people play this video in 5 years and say, look, Hartman was right, there's a crash, right? But I don't think it's going to happen. They're going to play the video saying, look, Hartman was right because there wasn't a crash. And what you have to have if you want to have a market crash is you have to have an oversupply of inventory, and you have to have a highly motivated, desperate, distressed seller in mass. Foreclosures. Right now, the number of properties in the United States that are in foreclosure are like 12. I'm joking.
Yeah. It's very few. Yeah.
Typically, at any given time, of all the mortgages out there, about 1% of those mortgages will be in foreclosure at any time. Good economy, bad economy, it just happens. Right now, we only have about 0.5% in foreclosure. About half the normal rate are in foreclosure now. But wait, there's more. If you actually dice up the cycle of the foreclosures, A foreclosure starts, and they have different names, but I'll use the California terminology. It starts with what's called an NOD, a notice of default, that is actually filed by the lender and recorded. It's a recording, a public record, okay? But before the notice of default, you've got months and months, or in some cases even years, of the borrower living in the property not paying the mortgage. Mm-hmm. And so the lender finally gets around to filing a notice of default. And then, and I'll use the California example, it varies by state, but California's got 40 million people, so it's really a good example because it's the most people I can talk about it in one place, right? 90 days for that, what's called the redemption period, right? Where they can just start paying the payments and then they've got the property back, right? It's out of foreclosure. They can pull it out of foreclosure by just catching up on the late payments. Then there's a 21-day period where they've got to completely pay off the loan to not go to the foreclosure sale. Now, here's what happens. So we've got the foreclosure rate running at half of the normal volume. It's a really low number. But even though 0.5% are going into foreclosure, almost nobody is finishing a foreclosure because they have other options. There are so few properties for sale, they can just stick it on the market. And even though the market is slower than it was, for sure, no question about that, they can still sell it. And the vast majority of these people are in positive equity situations. They're not underwater.
Yeah.
So it's nothing like it was during the financial crisis, during the Great Recession. This is like nothing like that at all. Like, to make those comparisons is insane. People are off their rocker if they're making those comparisons. It's just not the same thing. And I know the famous last words of any investor is, "This time it's different." I am well aware of that.
But this time it is different. No, you're right. And I think I've watched a lot of people too that really, and just that $5 trillion savings Americans have, is so much money on the sidelines. A lot of people are just waiting because they don't know what to do. And I think people are thinking there's going to be some sort of distress situation where real estate's going to go down significantly. And I look at the holding cost of holding cash, I think it's closer to 15% or higher as far as actual inflation. And so if you're just sitting in cash, so I'm about 95% deployed, and I'm trying to put as much money out to deals as I can. And I wonder if buying stuff now, and of course I'm in the multifamily world mostly, but buying stuff now when rates are a little higher, your buying price is fixed, but you can adjust the interest rate later potentially. But it could be that when rates start to drop, whether that's 3 months or 12 months or 2, whatever that is down the road, a lot of this money floods back in, and all of a sudden it's going to happen before that. Okay. Yeah.
And here's why. There's an old saying, money never sleeps, right? Okay. And I have done this long enough that I have seen this happen over and over, where we get into these little slow rut spots like we're in now, where it's kind of quiet, right? And sales, here's another thing. People look at the media and they don't really drill down on what is being said. There's a huge difference between sales volume and sales prices. Mm-hmm. Those are completely different things.
Totally.
Now, sales volume is way down. In California, I heard sales volume is down by like 37%. Right. Prices are not down by 37%, but sales volume is very slow in cyclical markets. That's a cyclical market. Okay, not the same as linear. But that's one thing to understand. The other thing we've got to realize is that people always have to do the best they can with what they have. You, of course, have heard and probably repeated the acronym that's used in the financial world, which is T.I.N.A, T.I.N.A. There is no alternative. And people simply look for the best available alternative they can find. Like you said, they know that if they keep their money in cash, inflation is eating them alive at the rate of 15% per year is your opinion. I believe it's about 17% per year. The government told us it was about 9.1, and now they lowered it to about 7. So whatever the number is, let's just call it 15%. You know what that means? If you kept your money in cash this year, you've lost 15%. If you had $1 million in cash, you lost 150 grand by keeping it in cash. Okay. If you put it in the S&P, you lost $350,000. And if you put it into the NASDAQ, you lost $450,000 in that example. Why do I say that? Because the S&P is down about 20% and the NASDAQ's down about 30% and inflation is 15%, right? But what do you compare it to? What if you just bought single family homes and you simply got a yield? You say the price stayed the same or it declined, who cares? You're not selling the property. You're simply investing for yield, for dividends, for cash flow, right? Well, if anyone goes to my website, jasonhartman.com, and they look at the properties there, they'll see the performance that are very realistic with vacancy assumptions, management costs, maintenance and repair costs, all of that's in there. And they'll see that those properties perform at about 20% or better annually. Now that's with the appreciation, take it out. Okay, take out the appreciation. But if you look at the principal reduction and the cash flow on the properties, right, you're still getting a very good return. And so you either lose it in cash or stocks or whatever, or precious metals recently, right? And certainly crypto, I don't have to mention that one, or you gain in real estate, right, with income property. Maybe you're not gaining as much as before, but it's still the T.I.N.A equation.
Yeah, and that's what people do. You're right. They look at the best available alternative. I've heard George Gammon say, really with the bulk of what we have, he says he puts about 80% of his net worth into assets that pay you to hold them. So that could be single family, it could be multifamily, it could be a whole slew of real estate assets that, typically, I mean, you get even more advantage because you could buy them with debt. You can buy them, not putting all the money down. You can have them leveraged, which is really amazing.
Let's just comment on that for a moment, because the show we did before, I know we're not talking about it today, but the key thing, and you just alluded to it, Bronson, is the hidden wealth creator that is inflation-induced debt destruction. Is just huge. It's just a huge benefit. So not only are you getting the return that I mentioned before, the principal pay down, the cash flow on the property, but you're also, inflation is chipping away at your loan balance. So that example where I said, oh, what if you have $1 million in cash in the bank, right? You lost $150,000 through inflation. Well, if you have $1 million in mortgage debt, the debt lost $150,000 in value. So that's the benefit to you. It's like you gaining $150,000 because inflation has paid off $150,000 of your debt. Amazing. Real estate investors love inflation, not just because the property goes up in value, but because the debt goes down in value.
Yeah. It's a double positive, right? In general, your property is going to be worth more over the years. And so that's obviously very positive, but you're paying off with future dollars that are worth less. So it's a really beautiful thing. And I use that term, the inflation-induced debt destruction, which I think
it's a mouthful, but it's great.
You have a trademark out on there. It's one of the Hartman tools. So, hey, I was going to ask you this, just on a side note here. There's a lot of news out there that's, fake news, that people, it all has an agenda. There's a lot of politics around stuff. It's been way more since COVID. What are some sources, or I guess, do you look at everything? Do you look at kind of both sides and then kind of make your opinion? Or are there some sources you find that these are sources that I just really like because it's just data, or it's just, anything you could do to maybe help investors that kind of want to do a little homework and just kind of look into some of this stuff as well without a lot of the political agenda. Do you have any suggestions on that?
Bronson, are you really trying to convince your followers that the mainstream media is not reliable?
No, not at all. Just, just slightly.
They have an agenda. You can't be serious.
So yeah, my question is there any, I guess alternative news and other things, but I just didn't know if there was other, I know Kenny there's things he looks at to look at multifamily properties and looking at, data in that sphere. And I just didn't know if there was some stuff that you look at that helps you.
To comment on the broader thing. Okay. And I've said this before, I was saying it during the COVID era. The biggest problem facing humanity, and this is the biggest problem facing humanity, and it's not COVID, it's not climate change, it's not anything that people think is the biggest problem. The biggest problem facing humanity is censorship.
Right.
It is the biggest problem. And all of the big disgusting tech companies are totally guilty of it. Apple, Amazon, of course, Facebook, and all the rest, Let's hope that Elon changes something for the better with Twitter. It looks like it's moving in a good direction, but we'll see. Folks, there's a reason that in the US Constitution, that was the greatest document ever written for the rights of humanity. The only one really before that ever was the Magna Carta. Okay. But then came the Constitution, and there's a reason that the First Amendment is first. Free speech, freedom of expression. Okay. Because the freedom of the press, that's what matters the most. Yeah. That's why it's first. It's so we remember it. We talk about it the most. No amendment is talked about more than the First Amendment because it's the most important. And I'd argue that the Second Amendment is the one that makes the First Amendment possible. So that's another discussion.
Yeah, maybe that's for when I have back as a guest in the future. But no, I appreciate that.
But as far as your question about sources, look, obviously a wide variety of sources, right? That's going to be good, right? To not just rely on one source for anything, but also any media that goes deep on things like we're doing here, deep discussions. I mean, look, I've been on television a number of times. I've been interviewed, and it's like, one of the anchors on television interviewing me, after the interview, we got to chatting, and he said that's why they call television the idiot's medium, because you get like a soundbite.
Yeah.
You can't have a deep thought in such short time. It's just not possible. So they have to make sensational headlines. They have to say ridiculous things. There's just no way you can comprehend what's going on with, say, the real estate market or anything else with television. And, on TV news, you get 38 minutes per hour of content.
Yeah.
22 minutes of commercials and station breaks and no non-content.
That's why, I never watch the news at all. I do written media, and it's even then, but it's so, depending on what source it is, you always have to consider the source as well. Jason, we're kind of getting toward the end of our time. I wanted to ask you a couple more questions though. For you, I look at you and you've been uber successful, super high net worth. You've done so many, different types of deals over the years. You've done, we're helped so many investors. You're doing all kinds of amazing stuff. If you were to go back and talk to your 20-year-old self, that was only 2 years ago. No, I'm kidding.
There's a lot more than that.
If you were to go back and give advice, or even somebody was 20 years old saying, hey, what would you do differently? What would you tell them? Well, what would you tell your younger self?
Oh gosh, I don't know. I definitely would have been more of a long-term thinker in terms of like buying and holding assets like properties. I mean, look, when you have a rental property, you have something everybody wants.
Yeah.
There's a shortage of that. And all of those construction materials and all of the stuff that makes it, all of the petroleum products, the energy that goes into it, the limited supply of land, all of that. But it's mostly the materials. It's the wood and the copper wire in the walls and the concrete and the glass and the steel and all of that stuff. These are things that are traded globally, that are not attached to any one currency, that are needed by every person on Earth. Every person on Earth needs to live inside of a structure, okay? And it's all built from those same basic ingredients: glass, steel, copper wire in the walls, petroleum products, concrete, lumber. It's these same basic things, right?
Yeah.
So it doesn't matter if the dollar exists or the euro exists or the yen or the Brazilian real or the Mexican peso. It doesn't matter. These things have intrinsic value. They're not financialized like so many other things in the economy. I mean, look, that's not fair. Everything's financialized to some degree nowadays, right? No question about it, but not like the other real fiat assets like stock, like cryptocurrency, which is interesting because the whole thing it's built at is being non-fiat, but it's really the most fiat. These are just things that have intrinsic value in and of themselves. I mean, if we were stranded on a desert island and there was no such thing as money, what would we do? As soon as it started to get dark, we would try to build ourselves a shelter, right? Mm-hmm. And I mean, it's just, it has intrinsic value.
Yeah, exactly. Yeah, there's no technology that's even on the horizon that people will not need a place a roof over their head or a place to sleep, right? There's nothing foreseeable. So it's
I'm
just,
glad you mentioned that, because like I looked at 3D printed homes a lot. I went deep on that about a year and a half ago. I considered starting a 3D printed home construction company of my own, because we have such a shortage of inventory. And that is not the disruptive technology. It's at least not even close. Maybe someday, I don't know, but yeah, it's just a lot of hype.